Welcome to Debits and Credits Made Easy, Accounting 101 for Beginners. I'm your host, Vimal Baba. I'm a CPA out of Arkansas. And before I start, I just want to remind you this presentation is for informational and educational purposes only. It does not constitute any professional tax, accounting, or financial advice. Please do consult a competent professional that understands your unique situation. And also, various trademarks and copyrights shown in this presentation are of their respective owners. Awesome, let's get started. So let's meet Sia and Drew, our two little characters that will be going through the educational journey of debits and credits. Sia and Drew are starting to take Accounting 101, and they are trying to understand debits and credits and are lost. The only things they can think of are debit cards and credit cards. But lucky them, they have a friend named Pinky who sells lots of balloons, and he tells them it's so simple, you should meet Al Crew, the accountant. So let's meet Al Crew. Al Crew, he is the gangster Al Capone's accountant brother. So we'll talk about Al Crew more here in a little second. So Al Crew first shows them just the basic formula of debits equals credits. In accounting, debits are on the left and credits are on the right. And here is a good old T account, which will make more sense later. But don't worry about memorizing it, just kind of know this exists. So then Al Crew tells them about the basic rules of accounting. Accounting transactions are recorded using debits and credits. Each transaction has to hit at least two accounts. Can be more, but at least two. The total of debits must equal the total of credits in each transaction. Again, debits equal credits. And then Al Crew tells them the E equals MC squared of accounting is assets equals liabilities plus equity. Don't worry about memorizing this, just kind of know this exists. And now, here on the left, if you see in green, we have Al Crew's initials, Al Crew. And you can memorize this to help you remember the main types of accounts in accounting. So A for assets, L for liabilities, C for capital or equity, R for revenue or income, E for expenses, W for withdrawals. Al Crew, the brother of gangster Al Capone. Just remember that. So, now we can go through each letter to kind of see what it means. So, A is for assets. It's what you own. L is liabilities, what you owe others. Like if you borrow money from the bank and you owe the bank money, that's a liability. If you borrow money from your brother or your sister, that's a liability. C is capital. That's money you've invested plus the difference between what you own and what you owe others. R is revenue or income. It's money that you collect from your customers for services or products that you sell. And E is for expenses, money you pay out for services, supplies, your employees, etc. Anything that you need to run your business. W is for withdrawals. That's profit distributions, draws. So it's money you take out of the business for your personal use. So again, memorize Al Crew, A-L-C-R-E-W. So now that we've seen what each letter in Al Crew stands for, let's look and see what the normal balance of each account type is. So normal balance meaning what's the positive balance side on the debits or credit side. Remember, debits on the left, credits on the right. So for assets, they have a normal balance on the left side, the debit side. Liabilities on the credit side, on the right side. Capital, credit side, they have a normal balance. Revenues, they have a normal balance on the credit side. So if you wanted to increase your revenue for accounting purposes, you credit the revenue account. And you have to debit something to offset it, which we're not going to get into the details right now. Expenses, your normal balance is on the debit side, on the left side. So if you want to buy something and increase the expense amount for that account, you debit the amount and you credit something. Withdrawals, also debit balance on the left side. So here's a snapshot of all those accounts we just talked about, the normal balances, and what you do to increase or decrease them. So real quick, assets, if you want to increase them, you debit. If you want to decrease, you credit. Liabilities, if you want to increase, you credit. If you want to decrease, you debit. Capital, if you want to increase, you credit. If you want to decrease, you debit. Revenues, if you want to increase, you credit. If you want to decrease, you debit. Expenses, if you want to increase, you debit. To decrease, you credit. And withdrawals, to increase, you debit, and to decrease, you credit. So now that our crew has shown the basics of the debits and credits, we're going to look at some examples. So the owners deposit $1,000 of their personal money to open a business bank account. A business bank account is an asset because you own that money or you own that account. So you debit your bank account for $1,000 on the left, and then the offset credit will be to capital, because remember, equity capital has a normal balance on the credit side. So you see we debit the asset and credit the owner's capital, and both debits and credits are equal. In this example, the business buys $500 worth of office supplies with their business debit card. So we will debit office supplies, which is an expense, for $500 to increase it. And now XYZ bank account, which is an asset to us, we are going to decrease by $500 because we used $500 of that money we had in the bank. So you see we debit the expense and credit or decrease the business bank account. And again, both debits and credits are equal. But wait a minute, Sia has a question. Why did you credit the bank account if we used a debit card? Doesn't make sense, right? Well, the bank account is an asset to us. We own it. So we have to credit the balance to decrease it, right? However, the bank is holding our money, which means they don't own it. They owe it to us at any time we ask for it, right? So since the bank owes us the money, it's our money, it is a liability to them. So to increase the liability, we would credit the account. To decrease the liability, we would debit the account. So this is happening on the bank's books. So anytime you go to a bank and you make a deposit, they give you a credit slip, meaning you deposited money. So on their books, they're increasing your account, which is a liability to them. And then whenever you buy something or you take money out of your bank account, they debit that account to decrease it on their books. So next time you go to the bank or next time you look at your bank account, just notice those two things. So then C and Drew were like, oh, that makes so much sense. Thank you so much. Our crew is like, you're welcome. And now our quick summary of everything we just kind of gone over. Remember, assets equal liabilities plus equity. And then you have your asset accounts, liabilities, equity, revenue, expenses. And all this should have a balancing entry every time. Debits should always equal credits. And memorize our crew. So now, Drew and Sia have a better understanding of debits and credits. Let's go study about our crew. Thank you. If you have any questions or need help, feel free to reach out to me.